Welcome back to Real Estate Economics Weekly Webinar Series. This week we're addressing the Austin Round Rock, Texas MSA. In our previous sections we've considered building permits, mortgage rates, we've evaluated home prices annually and on a year-to-year basis, we've evaluated employment and unemployment annually and on a year-to-year basis. And now we're ready to consider, is this market over or undersupplied, and is this market over or undervalued, and what's the repercussions to the market? Form your own opinions and we'll see what the data tells us. We can look at the valuation in this particular market and observe the incomes. Incomes tend to grow somewhat steadily, but they do oscillate. Times of good economic conditions, they grow much more quickly. Times of weak economic conditions, much more slowly. So how much does it take to own a home, to afford a median home in this market area? You can see at the center of the graph anywhere from $8 to $9, 10, sometimes $11 or $12,000. But look at the conditions today. Interest rates are so low that the cost of owning the median home in this particular market is as low as it's been for quite some time in terms of annual cost to own. That is a function of extraordinarily and artificially low interest rates. When those rates plummeted with Fed intervention in 2008, and continuing into 2009 and into 2010, this market became tremendously undervalued. It's undervalued since it's taking far less money to own a home in this particular market. Let me talk quickly to equilibrium home prices. Real estate economics, when we consider what is the equilibrium home price for this market, we consider the income base, the employment base, what type of industries are there. Is this area urbanizing and drawing in more employers and more employees? What's the regulatory environment and the fiscal environment for the state and locale? So each of these equilibrium prices as we move from market to market is unique. We don't apply a national or state factor to Austin. This is a price line that's completely unique to this particular area. So what does that tell us? At this point in time, this market is tremendously undervalued. Well, how come every home out there is not immediately scooped up if the undervaluation is as great as I say? There are many people trapped in homes that they've bought in the past 4 or 5 years that they can't release equity from. They're underwater, they're holding on, they think it'll come back. A lot of people don't want to sell at a number that won't get them the types of proceeds they need to move on. Poor consumer confidence, poor employment prospects. People are afraid to move, they don't know how good their job is if they still have one. So there's a whole variety of factors keeping people from acting on this undervaluation. But when the economic growth reemerges, people will quickly see that and act. What we see over the forecast period, though, is considerably higher rates from year to year to year, which will start to offset this annual mortgage cost advantage that we currently enjoy and turn the market ultimately back to an overvalued situation where it becomes much more expensive to own a home in the out years of our forecast due to higher rates. Let's consider the other side of the equation, which is supply and demand patterns. We know quite accurately what the total job situation is, and we can make strong, reliable forecasts out a few years on that. We know what the housing supply is, and we know what housing demand is. Those are related back to employment, which we've talked about extensively. You can see in this particular market that the conditions are characterized as overbuilt. As the employment base has declined, shrunk, in this particular area, the market's gone from underbuilt, where we didn't have enough homes for a rapidly growing employment base, to a situation where the current housing stock is too big for the existing employment base. And until we increase employment, get more jobs out there, this market's going to be characterized as overbuilt. There is some production, there is some supply increase in this market, but those numbers are pretty small, as we addressed previously in our permit section. So it's really a market that's driven by employment. So now we know that the market is generally overbuilt but undervalued. How do you respond to that? Well, who's active in the market? Entry-level buyers who don't have a home, relocation buyers who are moving into the market for employment opportunities, mature buyers who are moving from other high-cost states seeking lower ownership costs and lower cost of living. Those are the areas to be active in. We would seek out submarkets and neighborhoods where growing employers were located, that had good school districts, good freeway connections, and would concentrate there. If you've got a market area where the employers are somewhat old school or dirty industries or industries that don't have that good of growth prospects, we'd think twice about entering some of those areas. We're probably not going to see that great of demand for move-up housing. The people who would like to normally buy move-up housing are stuck in their current house and are having a hard time extracting any equity to make a move-up purchase. Luxury demand. Sometimes the luxury market has its own sort of source of demand, and there can tend to be some action up there, even in weak circumstances, but we don't know in this environment that there's going to be that great of luxury demand over the next few years. So what can we conclude about this? We think Texas has one of the best government models. We think the fiscal budgetary climate is good. We think the regulatory and the pro-employment policies are good. What happens when you have favorable employment policies in place is the market will tend to attract capital. People will decide, where am I going to open this business? Where am I going to open my new operation? And they will look to states that have these sort of characteristics and leave states that don't. That's all in Texas's favor and in Austin's favor. We know that housing construction's at an all-time low. We saw that in building permits. You can also see that in housing starts. We have fewer lenders making fewer construction loans. Well, what we've asked the banks to do here is to not lose any money, but at the same time make loans. Those goals are a little bit at opposite with each other. We've asked banks to grow their capital, to make sure they have a capital cushion for down times. And we've given the banks tremendous latitude in how they treat their REO, how they treat their commercial loans, how they treat their mortgage-backed securities, commercial and residential, if they own those, and given them the opportunity to grow their capital, recognizing that it's probably not adequate in many institutions at this time. So the institutions that have good capital may be more likely lenders. Those that don't are going to be very hesitant to take risks until their capital levels come up considerably. We think this is a drawn-out process, so we may be in an environment where there are relatively few capable and willing construction lenders, at least until a couple of years out. We know housing affordability is at an all-time high. We saw that as a function of interest rates. We've had a severe overcorrection in price, which really makes the housing stock more affordable than ever. And just we don't see buyers recognizing that. Confidence is low, employment conditions are poor, people are trapped in their current houses, and so that's not being widely recognized and acted on. We think distressed inventory is still out there, and the resolution to the distressed inventory isn't really accelerating. I think everyone's heard, maybe not necessarily in Texas, but across the nation, the period of time from initial delinquency to resolution has gotten very long. There's numbers out there of 40 months, 42 months, 43 months. If you read the paper recently, a number of banks have suspended foreclosures over paper and paper trail inadequacy. This problem may turn out to be a lot bigger than it appears on the surface. It looks like many of these lenders can't create the paper documentation necessary to complete the foreclosure. This is something that's going to be ripe for litigation and may just act to draw out the resolution of the distressed inventory, kick that can down the road, if you will. We'd like to address the point that distressed inventory isn't that great of an outlet for owner-occupant demand. Now, if you're interested in a neighborhood, you go out to an existing neighborhood, you don't know the financial situations of everybody who lives in that neighborhood. If they're under distress, if they're going to lose that home in the next 3 to 6 months and then sell that home at a value that's 10 or 20% below what you just paid, we don't think too many people have an appetite for that. Compare that to a new home environment where everyone's just been qualified for a loan, under relatively tight underwriting criteria, you're moving into an area where on paper and conceptually everyone seems strong. We think buyers pay a premium for that. The premium is probably something that shouldn't get too overstated, but there's certainly much more willingness of people to move into a new neighborhood than move into a neighborhood where their values are significantly at risk. We talked about demand coming from mature buyers. This has been a recession that's forced a lot of older and high-paid workers out of their jobs, and their prospects for some of these people is not that great. They may not be working at the same pay levels ever again. Many industries have contracted or disappeared, and some of those jobs are gone forever. Those people are going to extract equity from their high-value coastal areas, their high-value states, and look for new, attractive areas with lower housing costs and lower costs of living. Austin's a perfect outlet for that demand, and we think that manifests itself quite intensely over the next cycle. We also think that mobility is an important factor. We've seen that people haven't moved around that much in search of a job in this particular recession. We think as employment opportunities grow, that will become more important, and really to the next college graduate age, the people coming out to the market for the first time, we think they'll preserve their mobility and want to maintain that mobility at least until the point of time that they're secure in their careers, they like what they're doing, and they can consider putting down roots someplace. I'd like to talk quickly to what we do here at Real Estate Economics. Our over-under analysis with the 24-month read on market conditions is available in our Opportunity Risk Report. That's the basis for much of what we presented today. We do that in hundreds of MSAs across the country. Look at our website. You can see our coverage area. If there's an area you want that we don't cover, we can usually produce that in a week or two. We have national real estate consulting services, and here's really our areas of strength. We do quite a bit of asset valuation, as-is values, values as assuming homes are completed, future values, market entry values, what are the prices down the road? I own a piece of land. I might go out to market in 2012 or 2013, tell me what the appreciation looks like so I can make the best market entry. That's the types of things that we have extraordinary competence in. We also do what we call an asset value optimization. We take a current subdivision, a proposed subdivision, and we do a financial analysis and see how we can optimize the value of that land asset to its ownership. It's absolutely amazing that many of these assets are planned for one product or planned for one program, and we can drastically improve that, sometimes getting 50 or 100% improvement in the underlying asset value. I'm John Mulville. If there's any questions or you'd like to discuss anything we presented today, please call me. Here's my contact information and phone number, 949-502-5151. I'm at extension 102. Here's our team, Mark Babb, the principal and owner of Real Estate Economics at the left. I'm John at the top right. If you're interested in anything you saw today, we offer a variety of subscription products. Talk to Judy Duell at the bottom left. And if you're a current subscriber trying to get the most out of our products, please contact Sandy Rivera. She's happy to help you with that. I should probably mention that internally, our consulting group is the single biggest user of these products and programs, so we are intimately familiar with what they will do, including many of the subtleties and nuances that it would take quite some time to develop as an outside user. We are happy to share that with you and teach you anything that we can, so please just let us know if that's of interest to you. Thank you for joining us today for our Austin Round Rock webinar, and please join us for our top California market area webinar series that's ongoing at this particular time. Thank you, and join us again next week.